Fascinating. Stephen, stay right there because we're going to speak more about this with David Zervos himself. I know you're talking to about his views on all this. I especially want to spin it forward and look at what this economy might look like in the next 6 to 12 months. Dave, welcome. Dave's the chief market strategist at Jefferies. And I guess before I kind of get into the big picture, I want to make sure our viewers have a sense, Dave, of where these arguments are pointing in terms of market impact. All of this is paving the way for what kind of stock market and bond market for the time being, do you think?
So I think Steve alluded to a lot of this in his opening discussion, but a lot of this is just, it's very good for corporate profits. It's actually good for wages. It's a bigger pie to share. How that gets split up between capital income and labor income is debatable. But I think what we proved between Q1 of 2020 and Q1 of 2022 is that we can produce basically at or more GDP with, on average, about 8.5 million during the quarter workers, 8.5 million less workers. And it's an astounding fact. And it's got a good side and a bad side. The good side is, wow, we're really productive and we really adapted to this world where we went to less labor-intensive businesses. And the other part is, well, okay, what are we going to do with the fact that we've got a pretty serious unemployment problem still, right, and a lot of those jobs may not come back?
But here's what I find very interesting to ask both of you. So, Dave, I'll start with you. We are about to see this all slow down and change, though, aren't we? I mean, a portion of this will last, but the rest of the part that we're getting productivity gains from is from closed down parts of the economy that the public doesn't actually want closed down. They want to go to restaurants. They want to go to stores. They want to go to, the summer carnival. They want to go on cruise ships. They want all of these things that weren't operating in the pandemic are about to come back online in a big way. Isn't that going to increase the labor force, slow productivity, and reverse some of what you're talking about?
It may, but you also have to juxtapose that with what businesses that adapted to an online business model and reinvested in more of an online business model are going to do going forward. Are you going to build more showrooms if all of a sudden everything went virtual for your car sales, for example, or whatever big ticket item you were doing? I think the big question, and I don't want to dismiss what you're saying, there's definitely going to be a few million jobs probably added back that come into retail and hospitality. And again, those are going to be less productive because they're just more labor-intensive jobs. But what we really did is we had a recession, and as Steve said, productivity goes up after recessions. But we had a recession because we decided, or we had to decide to do things with less people or less interaction. And what that caused us to do was really innovate in the less interactive ways, all of these businesses. And I think that is much more here to stay than maybe people are thinking in the future. And it really portends a very different outlook for how a number of businesses outside of leisure and hospitality, whether it's financial services or whether it's transportation services or whether it's any form of goods production as well, it just means that more of a online or more of a virtual or a less labor
less in the real world.
will hold in the boardrooms.
Kelly?
And I think that's going to be a big difference in how this labor market bounces back.
Shepard Smith here. Thanks for watching CNBC on YouTube.